How to consistently grow a small account. Again, my name is Don Kaufman, and you're watching the TheoTrade presentation this evening. I start off with our infamous risk disclosure. All right, we're not a broker-dealer. We mention that all the time, specifically because I spent about 15 years in the brokerage world. I'll discuss this a little bit kind of later on throughout the course of the evening. Copyright disclosure, this is ours, this is not yours. I also throw this up here simply because we want you to know that you can contact us after this evening. We're available. We actually answer emails. We answer the phone as well. We're based right here in Scottsdale, Arizona. For those of you that know the Scottsdale area, it's North Scottsdale, right? So if you ever need to get a hold of me after this evening, just hit us up, support@theotrade.com. We actually use a common inbox, so you could actually put, hey, I want this to go to Don. I'll answer your email. Yes, I answer emails. Support@theotrade.com is how to get a hold of us. All right, with that, and again, those are some of our formalities before really getting off and running. Let's get down to it, okay? This is why you're here. By the end of the webcast, this evening, I want you to be able to walk away with some of the following knowledge. First point, why traders and investors alike, they just outright fail with a lot of the strategies they embark upon. I'm actually going to exploit an area where a lot of traders and investors, even experienced traders and investors, outright fail. We'll actually talk about that here in the next couple of moments. Number 2 over here, why you need to be cutting risk in order to produce consistent 55% returns surrounding high probability movements in any stock, ETF, or index. This will become much clearer. Why do you have to cut risk? Okay. You have to cut risk to become more consistent, which you're going to learn here again momentarily. Number 3, learn to grow an account with high degrees of consistency, even in a world filled with tweets. I like point number 3. I added this really very recently when you start to think about the overall marketplace. People, you're one tweet away, okay, from a massive, just massive market move. You realize that, people right now, okay, are making and losing hundreds of thousands of dollars a day based on a tweet. Kind of curious how many of you guys have actually been caught in the crossfire of one of those tweets at some point. And of course, number 4, how you can trade without having to continually monitor your positions. We're actually going to talk about set it and forget it, which is a type of a good till canceled order, but it's all about the strategy, and it's a high probability strategy that we're going to kind of surround this set and forget, all right, type order. So again, bear with me as we're actually going to take you through each one of these in quite some detail this evening. Again, of course, that's why you're here. Our gift to you, okay? Stay with me until the end of the webcast tonight. We have a little bit of a gift for you. SPX expected move indicator. This is something I talk about extensively. We're actually going to give it to you again at the end of this webcast. Okay, for those of you that are willing to stay tuned the entire time, fantastic. 3 years of expected moves. All right, they're all of my hand calculated expected moves, and it's an indicator that's going to change the way that you view the markets. If you've never seen it before, I'm going to show it to you here momentarily. It's $197 value tonight. Again, it's something I use day in and day out. I talk about it, okay, incessantly. I use it continually to create trades in and around. This is the weekly expected move. There are ranges in the S&P 500 index options. They're derived from the options chain. The highlighted candles are breaches of expected move at week's end. The study defines efficiency or lack thereof in the markets and assists in the knowledge of selling versus buying premium. So what you're looking at right now on your screen is an expected move study. These little hash marks, okay, they define. By the way, this is literally today. This screenshot was taken, today. And you can see this is where the week started. This is the upper edge and the lower edge. It's the anticipation of movement, okay, inside of the overall market. It's the S&P 500, okay? Those highlighted areas, those are breaches of expected move. How Some of you may or may not be familiar with this idea. Okay. You will become very familiar with this idea if you tune into some of the education that we provide here at TheoTrade. Now, again, you must stay tuned to the very end of the webcast, and I will give you a very specific link where you can actually go ahead and retrieve that SPX expected move indicator. All right. Housekeeping items. Listen, what you're going to learn tonight is a skill set. I'm going to throw that out there right now, okay? This isn't, follow the bouncing ball, red and green flashing arrows. This is not a bunch of, garbage hype. This is a skill set. You got to pay attention. You're going to have to learn something tonight, right? That okay with everybody? I always tell people, shut the door, turn off Skype, chat, okay? Facebook, whatever else distracting you. Maybe put your phone on silent mode if that works for you. Definitely kick kids out. Grandkids, kick them out too. The dog can stay, all right? Dog, if it's quiet, keep the dog. Dog's good footrest over there, right? Keeps the feet warm at this time of the year, especially if you're in Canada. Listen, you took the time to be here. This is extremely important. Focus on being here. I'm going to go through, again, quite a bit inside of the next hour. And it's a little overwhelming if this is the first time you guys have been here. All right. So those are my housekeeping items. Again, focus. You're going to want to focus because I'm telling you, we're going to move, okay, at a very rapid clip. And I want to make sure that everybody's on the same page. You'll even hear me from time to time this evening kind of pause and be like, are you with me? And that's important to me, right? I want to make sure, like, hey, listen, you got to walk away with the skills that I talked about just a moment ago. Okay. I watched order flow for 15 years. I mean, that's why I'm here. I grew up around traders, and I started trading in the late 90s. When I say I grew up around traders, I had family members that were traders in Chicago from the 1970s. I actually had a family member that had, at one point, owned over 500 seats, at the same time, on exchanges all over the world. So I started trading in the late 90s. I moved upstairs very shortly after I started trading in Chicago as a risk manager. I was then invited to a startup brokerage firm. That brokerage firm was called Thinkorswim. I worked there from basically 2001 until 2015. At the time that I worked for Thinkorswim, I built their entire education division. Then we were eventually merged into TD Ameritrade. I was there when we took the company public in 2007. Then we were acquired by TD Ameritrade. In that time, I ran education for both firms. Okay. And I had access to the largest retail order flow in the entire industry. When I was at TD Ameritrade, I had direct access to study over 7 million brokerage accounts. Okay. And people always ask me, well, what good is that? Because it's watching order flow. Like, what's good? What's watching order flow? It means I had access to everything you did. Okay, I can tell you every nuance and every mistake, pretty much of every trader. And I'm going to exploit some of those this evening, and I hope you don't mind. But that's where good logical strategies come from. Comes from exploiting, okay, the knowledge of others' order flow. Listen, we studied trades. We know what works and what does not. Okay, what you learn here comes from watching billions of dollars in others' mistakes and the knowledge of what works best for retail traders. It's a little bit about kind of my background, where I got started. Again, traded in Chicago, went to the retail brokerage world, traded throughout the last, we're at 22 years now of trading. With that, it's me. I'm still doing some TD Ameritrade TV from time to time. This is actually in studio, looks like just a couple of months ago. I've also done a couple of CNBC tours over the time. This is myself versus none other than the head shark, Mr. Wonderful himself. I don't want to ruin it for you, but he could not have been a nicer individual. With that, let's get down to it. Let's start to talk about strategy. Let's talk first about risk. Risk. Listen. Your money is on the line, all right? And what you're going to learn in this business over time is how you handle your risk is actually directly correlated to your success in the markets. Too much risk. What's going to happen? Well, you're going to panic, all right? Anybody here ever done that before? You're going to panic. You're going to close positions continuously at the worst time. But, the one thing I've learned over the years, people are very consistent with their panic, right? I'm going to poke a little fun at you with these, and you kind of have to. After you've done this, enough years, it's painful sometimes to watch that people do the same thing again and again and again and again. And that's why I do, again, poke some fun at it. But I've literally looked at hundreds of thousands of accounts. You figure out what works, what doesn't. And the frustrating thing is what does not work just gets repeated over and over and over again. That's why I throw the picture over here. That is a Mac computer with somebody throwing their guts up. I don't know if you guys have heard that terminology before, but they call it puking your position. That is to signify puking up your position. I couldn't think of a better artist, rendition of that before. But listen, I put this up here because you got to figure out for you what works. Here's what works. You got to follow a system that's been sourced from hundreds of thousands of people like you. Listen, there are things that I can do in this business, and I'm just going to level with you. There's things that I can do in this business. I'm probably going to be faster on technology than you. I'm probably going to be able to take more risk, okay, than most of you. That's not going to help you at all, okay? We got to actually source what's going to work specifically for you. We have to turn around, we have to cut losses and use a repeatable strategy to obtain incremental returns. What you got to learn is successful trading strategies exemplify, okay, the following principles I am about to point out, okay? Also, I want everybody to recognize at this point, there's no home runs in this business. Success, it's got to be a series of small wins. Incremental returns, consistency. You're going to hear me say that a lot tonight. Incremental returns. I know everybody attends some sessions. Follow this system. It's red and green flashing arrows and you're going to be right. Okay. Listen, you're not. You got to actually have principles to be able to get in and out of the trade. Let's actually go through some of those right now. So this is what we call principles of building a trade. Trade logic, capital allocation, directional bias. Okay. Here at TheoTrade, when you approach markets, everything that we do is going to be, following this approach. Trade logic, allocation, directional bias. Now, you may or may not be familiar with some of these terms, and I'm going to take you through some of this terminology. And then, of course, what we're going to do is we're going to strategize around, these principles, meaning that we're going to follow, this logical progression. So what is it? What is trade logic? Trade logic. Place strategy and trade logic first. Listen, the vast majority of people, involved in markets are infatuated with market direction, right? You're bombarded with it. CNBC. What does CNBC do? Where do you think the stock is going to go? I don't know. Where is Apple going to go? And they have one analyst that's really bullish on Apple. The next analyst is really bearish on Apple. By the end of watching CNBC, you're completely and totally confused, but you kind of like Bob Pisani on the floor of the New York Stock Exchange, so you keep watching. It's getting ridiculous out there. Listen, trade logic isn't, it isn't about being right or wrong. It's not about predicting the next move. It's the right strategy. It's the right strategy, though, coupled with established entry and exit criteria. You do not necessarily then have to be right in picking a direction in a stock or the markets in order to be profitable. So we're going to rely very heavily, on strategy, and more appropriately than just use the term strategy, it's trade logic. I mean, I'm just going to give you a little analogy. Do you believe that a trading firm, that has billions of dollars, do they go out there and they just go, well, I think Apple's going up, so what the heck? Let's just go out and buy some Apple today. It seems like a good idea. I mean, lately that probably would have worked in Apple, but the point that I'm making, there's no logic to that. Where's the mathematics behind it? Where's the point where they actually say okay, this is how we're going to make money. Can you prove how you're going to make money in this business? Anybody? Again, these are not rhetorical questions. You guys can chat in a little bit and you may go back and forth. So trade logic, which I'm going to explain here momentarily, has got to be first. It's got to be first. You got to follow the progression. You got to have trade logic. Next, capital allocation. This is kind of ironic, but how and where you allocate capital should be strongly considered as a viable portion of your trading methodology. Capital allocation, I'm going to argue this one to the death, will take precedence over being right in the markets. You're going to see why here momentarily. how much capital you put in a trade or an investment will actually take precedence over being right in the markets. Right? I'm going to leave that one right there. We're going to come back to it in just a moment. Directional bias. I'm not anti-charts. We're not anti-chartists. We're not anti, red and green flashing arrows or scanning. I'm all for it. But we recognize where you think a stock might go, the market does not always agree with your sentiments. And for every time that you're bullish, somebody else is bearish and vice versa. Being right directionally cannot define us as investors or traders, for we may not be right often enough. You got to remember, these steps, this progression getting into stuff. Almost everything, that you're bombarded with in this business is about directional bias. And we're not saying that directional bias is secondary. Quite the contrary. We're saying it's tertiary. It's the third thing on our list. Duration over direction. Listen, how and where you allocate capital can define not only losses, but it can be the defining factor in your overall success or failure in the markets. Our war cry, duration over direction. You need to be capable of sustaining trades long enough to be profitable. Now, for just a moment, I go back and I'll reiterate this. Trade logic, the right strategy. The right strategy that you can actually say like, hey, if I do this again and again and again and again, is this going to work? Number 2, capital allocation. Capital allocation. What's capital allocation? Allocate too much, you're dead. Anybody ever done that before? You literally put just a little bit too much, and what do? You panic. And you panic at the worst possible time. And it's not because you weren't right. You panicked out of the trade because you had too much allocation. Allocation is more important than directional bias. As I said, I'll fight that one to the absolute death over there. You have to be able to sustain positions long enough to be profitable. Now, you want to be right or you want to be happy. It's kind of ironic. My wife does frequently remind me of the famous phrase, you want to be right or you want to be happy. I am not good at applying that to my marriage, but the logic works beautifully in trade. I always take the stance, you don't have to be right to be able to make money in this business. And of course, everybody goes, well, why? Experience, watching order flow for decades has taught us invaluable lessons. I mean, think about this. Have you ever been stopped out of a trade? And by the way, these are not rhetorical questions. This is the point where you should hop in here and say, like, yes, no. Have you ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? And I pause there for a second because it's important that you identify what you are, who you are, what's occurred for you. So the question over here, why'd you get stopped out? Why'd you bail out of a trade? Because the point that I'm making with this, the point that I'm trying to make with this, you get stopped out, you bail out, you puke out of the position, you panic, there's fear. The point that I'm making goes right back to what I said about direction. You panicked out of a trade. It doesn't mean that you were directionally wrong. You panicked out of a trade, because you either had bad trade logic or you just overallocated, right? It wasn't that you were just wrong and dead wrong. And with that, we have to overcome this. And with that, we're going to come in now to a core strategy and more importantly, a trade logic. Today, I want to introduce you to one real world strategy that you can start using tomorrow. Now, what we try to do here is very risk averse. And before I dive head on into strategy and trade logic, what I really want to do, but first, we're going to talk a little bit about risk versus reward. And the reason we're going to do this is I want you to understand some of the logic, some of the progression, in this business of trading. Listen, you want to learn about trading? It's fantastic, But you have to learn a couple of nuts and bolts and a little nuances, a little background information before you dive head on into this. Whatever profession you're involved in, I probably couldn't just dive head on into it. I'm sure that there's some logical progression, some skill set. And so, same thing here, We first got to talk about risk versus reward. When you first learn about markets and trading, we're often exposed to these ideas, right? Risk reward. I don't know, risk 1 to be able to make 2. It's a common strategic entrance to the marketplace. Okay? How many people have actually done this? I'm going to go out there, I'm going to risk 1 to be able to make 2. It actually works, right? Maybe not. Okay? This is probably the most common strategic entrance for people to the marketplace. They go out, they risk a buck to be able to try to make 2. However, have you ever looked at the probabilities behind this idea? So what we're going to do for a moment to make sure that you understand what trade logic really amounts to is I'm going to teach you a little bit about risk reward. More importantly, I'm going to debunk risk versus reward. Let's take a look at the following example. So I've got a couple of examples set up for you tonight, and well, here's the first one. So in this first example, what we are going to do is we're going to buy a stock. So here's a stock, and that stock is trading right smack at 53. So you're going to go out, okay, and you have a stock. Stock's trading at 53 bucks, and you're going to go ahead and you're going to set a stop order. So stop at 52, and then you're going to set a target price. There's your target, bullseye, and that thing is going to be right at 55. Now, you can actually set up this entire position. We're going to go out and we literally buy the stock, set a stop at 52, set a target price at 55. Seem reasonable to everybody? Okay. So if you're wrong, what are you going to lose? If you're wrong, you're going to lose how much? A buck. If you're right, what are you going to make? 2. Okay. That's just, again, the prototypical, right? Risk 1 to be able to make 2 scenario. I don't care about the time frame. I don't care if this is a month, this is 2 months. Listen, in a month, I'm pretty sure this stock is going to move up $2 or down $2, whatever the stock happens to be. But do we get, this example? How many of you have ever gone out and put on something maybe similar to this and similar to this logic? I'll just blank the screen. Put on something similar to this logic. We go out, risk 1 to be able to make 2. This could be done with stock. It could be done with options. It could be done with futures. Okay? Let's now look at what we term probabilities in your trading. What's more likely? Okay? In a normal volatility setting, getting stopped out at 52 or making the $2 profit, what's more likely to occur? All right, so let's go back and let's review this from a purely mathematical sense. So here's that stock once again, and it's trading right at 53. So will it go down to 52 and hit your stop, okay, or hit your target at 55? What is a more likely probability? Now, I want you to assume that you're not going to do this one time, okay? Because when I bring this up and I say, okay, what's the chances of, hitting that target of 55 versus going to 52? And inevitably, somebody comes in here, they say, well, Don, I used a MACD, I had my Fibonacci, my Bollinger Band said, okay, I don't care. I wanted you to look at this from a pure mathematical standpoint. I want you to assume that you're not going to do this one time. I want you to assume that you're going to do this, okay, hundreds of times, possibly even thousands of times over the life, okay, of your trading. What is a more viable probability? Hitting the 52 or hitting 55? Is it more likely a stock to go down $1 or up 2? Okay, from a purely mathematical standpoint, what's going to happen? Okay, and most people are getting it over here. There's a much higher probability of hitting 52, okay, before hitting 55 in any normal volatility fluctuation. And when I say normal volatility, it doesn't mean that you're wrong directionally. It's just a normal move. You go down to 52 and then you go up 55. That it is what it is, but you're still going to lose money, okay? And that's a point. So I want you to recognize that. Now let's get down deeper into it. Options or probabilities? Well, a lot of people look at this and they think to themselves, I don't know about options. Maybe you never looked at options. Maybe you've never traded options. However, are you aware that you could use the option markets, okay, to actually decipher this? Options, they're probabilities. Options can help us in determining the viability and practicality of any given trading strategy. How, why, where? I'm going to show you that. Let us look at what the probabilities are in the aforementioned risk 1 to be able to make 2 trading setup. And let's see if this is viable over the duration. Guys, ready? Okay, listen, we're not going to be in Disneyland anymore. So from here on out, we're going to start to get deep. All I want to know, okay, is in this scenario, I want to know the precise probability. Okay, I'm not playing around anymore. I want to know what's the probability of hitting 52 versus what's the probability of hitting 55, let's say in the next month. In the next month. Is that a reasonable example? Okay, here's your answer. So we're actually going to go into a stock. Stock! Okay, doesn't matter what stock it is. In this case, I'm going to use Oracle. Oracle actually just recently had their earnings. You know why I selected Oracle? Because it's trading right smack at $55 on the button. It's trading at $55. Sorry, $53. I apologize. $53 on the button, which it just couldn't be a cleaner example. $53. So assume that you went out and bought the stock right at 53. Well, what's the probability of it going to 52? Now, I know there's a lot of numbers going on the screen over here, but this is about probabilities being exposed. And we have a probability in the options chain. We have a probability. It's called probability of touching. You know what probability of touching is? It's the probability anytime, okay, in this example, 38 days, okay, it's the probability anytime in the next 38 days of hitting a particular level. The level here is 52. Okay, so the probability of touching the 52 level in this case is 71%. Okay, the probability of touching the 55 level in this case is 40%. This, okay, is your risk one to be able to make two scenario. Okay, the risk one will be stopped out about 71% of the time. To be able to make two, okay, you'll hit it about 40% of the time. This is not necessarily like the most horrific trade ever. What you're going to find out, though, is you're going to get stopped out considerably more. It's not going to matter how good you are at picking direction. I don't care if you're picking direction 80% of the time accurately, because you're still going to get stopped out early 71% of the time. By the way, these probability of touching numbers, people inevitably ask me, like, how accurate are those? Well, I don't know. There's billions of dollars traded in this options market. I'm probably going to settle on the fact that these are deadly accurate over time. But when you have a 71% chance of getting stopped out, how does that grab you? Because you could be right. And the point that I'm making with this is you could be right 70, even 80% of the time. People all the time, they come to me and they go, I'm right. Okay? I'm right all the time. And I'm still losing money. How's that possible? Because they have the wrong strategy. Strategy's everything. This is risk versus reward revealed. In the aforementioned Oracle example, okay, the probability of hitting the stop of 52 is 71%. The probability of hitting the target price at 55 is 40%. The risk one to be able to make two scenario is a setup for a low probability disaster. Okay? And that's, I mean, again, hard and fast over here. So that's, by the way, somebody was asking me about, probabilities and so forth. Okay. Probabilities have been around since options have been around. Every major trading application has probabilities these days. Every major trading application has probabilities. Very, very few people know how to use these probabilities. Okay. If you knew, and somebody came to you and goes, yeah, risk one to be able to make two. Yeah. And then you said, well, yeah, but there's a 71% chance of getting stopped out. Most people would be like shaking their head. They go, I don't even know. How do you possibly know that? You should know that. How could you not know that? I mean, if somebody came to you and said, hey, that's a great trade. You go, yeah, but it has a 71% chance of getting stopped out. You go, that's the worst trade I've ever seen. It's flushing money down a toilet. Risk one to be able to make two in every scenario. Okay. And by the way, it's not just, one or two underlyings. I could take you into underlying after underlying after underlying. I was looking at this earlier. Okay. Starbucks. Starbucks is an $88 stock. I could do the exact same thing in Starbucks. Look, it's an $88 stock. Go to the 87s. Okay. And then maybe, if you're going to risk $1, be able to make two. So go all the way up to the 90. Okay. Here, you want to see it? Here's your probability right there. 75%. Okay. And about 58%, 59%. I just want to show you it's not just in Oracle. It's not like a perfect example that I'm pulling out of thin air. It's in everything. Okay, this is through and through and through. If you use stops, you have an incredibly high probability. Like, you want to get into a trade where you have a 75% chance of getting stopped out? Of course not. It's a low probability disaster setup. You got to position your portfolio with the right trade logic. Let's get down and dirty. How do you position yourself most effectively without exposing yourself to drastic risks and or a low probability? Okay? Would you be interested in a trading strategy that, first of all, overcomes the high probability being stopped out? Number 2, defines your risk. Number 3, provides a high probability of success. Number 4, limits capital exposure. And number 5, you never need to buy or sell the stock. Okay? Those are the attributes of the strategy that we're about to embark upon. High probability, okay, you're never going to be stopped out. You can't be stopped out of the strategy I'm about to show you. It's going to define your risk. It has a high probability of success. Limits your capital exposure. You're never going to have to trade the stock. Enter the in-out spread. In-out spreads are all about, okay, designing a trade to limit exposure and to maximize potential with very minimal movement in the underlying. Yes, in-out spreads, they're options trades. I said the O word. They're option trades. Please, fear not anything in options. Okay? As the option spreads, they are what allow us to limit our risks without the use of stop orders, okay? While providing considerable upside potential. You know, one of the biggest arguments for option trades years ago used to always be, what about commissions? What about commissions? They've fallen to next to zero. Options, okay, they're utopia in these days. Okay? They're utopia in these days. And that's something I have continually and will continually point out to you. Let's actually take it down. Okay, let's go to in-out spreads. Let's explain them a little bit and what an in-out spread happens to be. So most people, they go out and they just outright buy stock. So they just buy a stock. And that stock, I don't care if the stock's trading right at 100. They buy the stock. What do? They buy the stock and they hope the stock does what? Goes up. Okay, that's great. And what happens if it doesn't go up? What if it actually gaps down on an earnings announcement and the thing ends up at 85? What happens if it pulls an FDX? Did anybody see FedEx after hours? I think it closed at like 163 and then the next trade was like 152. Whoops! Okay, missed a little bit there. But the point I'm making, stock, okay, it's just crazy. There's just too much risk. So here we do have a stock, okay? Stock. By the way, I like to call every stock stock. And the stock is trading, let's say, at 100. Do we own the stock? Nope. We do not own the stock. Why? I don't want to own the stock. Why don't I want to own the stock? Because I don't have to. I'm going to go out instead, and I'm actually going to use options. Okay? I'm going to use what we term an in-out spread. So bear with me. I'm going to take you through an example. If you've never traded options before, I want to know about it. Chat in right now. If you've never traded options, you go, this is new to me. I am a little bit lost. That's good. Okay? We got to start somewhere. So I want you to go out and I want you to think about, we're going to go out and we're going to do what's called buy, all right, a 99 call. We're going to buy a 99 call. Now, a lot of people that are brand new, they go, I don't even know what a call is. A call gives you the right to buy. Buy the what? Buy the stock. At what price? 99. Okay? You're going to pay something for that. What are you going to pay? We're going to say $2. Okay? So we're going to go out here right now and we're going to buy a 99 call, okay? And we're going to pay a whopping $2. $2. Buy a 99 call. Now let's talk about the 99 call. First of all, the 99 call is going to be good for 1 month of time. So a 99 call. The stock's trading at 100. You have a 99 call. What's a 99 call give you the right to do? Gives you the right to buy the stock at 99. Do you want to buy the stock at 99? No. Then why are you buying the 99 call? Because I want the right to buy the stock at 99. You think about that for a second. Nobody goes out and buys an option because they really want to buy the stock at 99. I mean, you could buy the stock at 99 because options give you rights. Options give you rights. What's your right if you buy the 99 call? I have the right to buy the stock at 99. But why would you buy the stock at 99? Because if you have the 99 call, and let's say the stock went crazy, the stock went all the way to 110. What's a 99 call going to be worth with the stock way up here? Okay, let's say the stock goes all the way up here, okay, to 110. If you have the right to buy the stock at 99 and everybody else in the world has to pay 110 for it, okay, what is that call going to be worth? You guys tell me. Okay, you have a 99 call, gives you the right to buy the stock at 99. If you have the right to buy the stock at 99, can you buy the stock at 99? Yes. But if you bought the stock at 99 and you sold the stock at 110, what would you make? I would make $11. What'd you pay for it? $2, $2, $2, $2. Okay, that's what a 99 call happens to be. Okay, and for those of you that are brand new to this, know that a 99 call unequivocally gives you the right to buy the stock at 99, and that 99 call will be worth a minimum of $11 if the stock goes all the way up to 110. Okay, and that 99 call, it's only good for a month. But there's a problem with the 99 call. You want to know what the problem with the 99 call is? What if you're wrong? You're going to lose $2. Losing $2 beats the hell out of losing 100, right? It does. But you're still going to lose $2. What happens if the stock stays flat? If the stock stays right at 100, you paid $2 for that thing. Okay, if you buy a 99 call, you don't need the stock at, 100? You need the stock at 101 just to be able to do what? To break even. I don't like this. We're not just going to go out and buy the 99 call. We're simultaneously going to sell, okay, a 101 call. Now, sell a 101 call. And that 101 call, okay, it's going to be trading for $1. That's a $1 credit. Now, bear with me. We're going to buy the 99 call, and then we're going to sell a 101 call against it. And we're actually going to, when you sell something, you collect $1. And this entire trade, okay, what am I actually paying for it? It's a $1, what we term debit. Now, time out for a second. I'm buying the 99 call and I'm selling a 101 call. Let's talk about that 101 call, because if you're brand new to options, look at the 101 call. I'm scared. I'm getting heart palpitations. How did you sell something that you never owned? Well, because in options, you could buy options or you can sell options. But selling options sells you into an obligation. Sells you into an obligation. What's your obligation? To give somebody your stock at 101. So right now, what do you have? You have the right to buy the stock at 99, but you have to give somebody else your stock at 101, and you never even own the stock. And you're like, I'm so confused. Well, let's think about this for a second. If you have the right to buy the stock at 99, can you buy the stock at 99? Yep. But if somebody has the right to take stock from you at 101, will they take stock from you at 101 if the stock goes all the way up here to 110? Will they take the stock from you at 101? Yep. What do you get to make? Well, if you buy the stock at 99, you have to give it to them at 101. The most you could possibly make in a $2 wide spread is $2. What did you pay for that? $1. You can't make more than $2 on this trade. What did you pay for it? $1. Now, this is the big one over here. This is the big one. You go, why would I want to do that strategy? Why? Why? That's exactly what we're going to get to. Okay? People, they miss the logic. This is as simple as you want to put it. You can call it a debit spread. Some people call it a debit spread. This, though, is specific. It's strategy. It's an in-out spread. It's much beyond just the ideals of a debit spread. There's so much more in here. So you have the right to buy the stock at 99. Somebody could take stock from you at 101. The most you could possibly make in this trade is $2. What's the most you could possibly lose? $1. Why would you want to do this trade? Because in the end, with all of this being said, what you were doing in here, okay, is you were risking $1, okay, to what? Make $1. I know there's a lot going on my screen here. You're risking $1 to be able to make $1. Risk $1 to be able to make $1. Risk $1 to make $1. Why would you ever want to do that? Why would you ever want to do this trade? First of all, here's where the stock starts. Follow me in this logic, and we'll go through it again and again and again and again. Okay? Follow me with this. If you go out and do this trade, you're risking $1 to be able to make $1. Risk $1 to make $1. Risk $1 to make $1. How do I know it's risk $1 to make $1? Because you paid $1. What's the most you can make? $2. Of that $2, okay, that you could possibly make, of the $2 you could possibly make, you already paid $1 up front, so it's risk $1 to be able to make $1. Know that. Right? Why do we like this strategy? Well, let's say that you put this thing on. This is bullish. You want the stock to go up. You want that stock to go all the way up to 110. But this is your stock. Your stock never goes up. Your stock goes down. All of a sudden, your stock is trading for 90 bucks. Follow me. The stock goes all the way down to 90. You're like, Did you get stopped out? No. Why? Because there's no stop order. What'd you lose? Right now, you're down $1. You're down $1. But wait a second. You still have 3 weeks left. What can happen in the next 3 weeks? I don't know. Maybe the stock comes back up. Maybe the stock comes all the way back up to 102. Gold and beautiful. You're out. You're profitable. What this strategy basically does, yes, you're risking $1 to be able to make $1, but the probability of you making the dollar is considerably higher than losing $1. Think about it. You don't get stopped out. It makes you impervious to the downside. It makes you impervious to risk. That's one of the keys to trade logic. Got it? Get it? Because we're going to move on. Why are we moving on? Because I'm going to show you another example. Get impervious to the downside. Who cares? Oh no, the stock sold off. I'm down $1. Okay? I'll see you on the other side. That basically means we'll see you when the market moves. It's not about direction. It's about strategy. In-out spreads, right? So I'm going to give this is an Oracle example. I was looking at AMD earlier. This is an Oracle example, okay? But we're going to use an in-out spread rather than stock and stop orders. Rather than buying the stock, okay, at $53, we're going to use a spread, okay, to limit risks and provide a high probability, okay, without the use of stops. So I'm going to do an in-out spread now in Oracle. Here it is. Okay. Remember a moment ago we were talking about stop orders and we're like, well, let's go out there, let's buy the stock at 53 and let's set a stop order at 52. Forget all that garbage. Instead, let's look at Oracle and let's look at an in-out spread because this is exactly what we just lined up moments ago. And I want to make sure, because I had a couple of different examples over here, I want to make sure we get this perfectly correct because I see an issue on here and I want to get it just right so everybody understands exactly where we're at. This one should say 52. This one should say 54. We're all good. Okay. Here we go. First of all, the stock is trading at 53. Let me ask you something. Do we own the stock? No, we don't own the stock. Instead, we went out there and we buy a 52 call. We bought it for $1.60. Then we turn around and we sell the 54 call against it. This is our spread. Let me ask you something. What's the most you can make on a $2 wide, okay, spread? What's the most you can make on a $2 wide spread? Well, I think you can make $2. $2. Can't make more than $2, of which you paid $1 up front. Okay. Now let's talk about the logic of it. Forget about people get all tied up and they're like, wait, so I bought the 52 call. What does the 52 call give you the right to do? Buy the stock at 52. What does the 54 call give somebody else the right to do? Take your stock from you at 54. So if you buy a 52 call, you buy the stock at 52. If you sell a 54 call, somebody can take stock from you at 54. What's the most you can make? $2. Even if the stock goes to 100, you can still only make $2. You go, why would I want to limit what I can make? Because you're also going to limit your losses. Right? So in this strategy, you're risking $1. How much can you make? Well, you can make $2. You can make $2 on the width of the spread, of which you paid $1 up front. So you can make $1. Now, let's go back and let's review. Why might I want to do this strategy? Okay? And this is no, gimmick over here. I'm going to show you it in real context in a moment. Listen, risk $1 to be able to make $1. Why? Because the stock can actually go down. You could be wrong. You could be dead wrong. You could be flat on your face. The stock's all the way down now at 50. You're like, I can't take it. There's an extraordinarily high probability in a normal market oscillation that at some point during the life of this trade, that will come above 54. I'm going to say that again. In the normal oscillation of a marketplace, the stock is at 53. Even if the market moves against you, there is an incredibly high probability at some point during the life of this trade, okay, that it comes back. I'm not even including, I don't care whether you use a MACD or a Fibonacci or a Bollinger Band stochastic. If you think that you're going to be right more than you're wrong, then you're going to make a ton of money with these types of spreads. A ton of money, okay? Because these spreads, they overcome, okay, the need to use stop orders. They overcome the need to panic out. Here's something that, you know what? What could happen to you worst case in this? I'll tell you worst case. The stock goes down to $30. If the stock's trading at $30, whatever, you lose $1. You'll live to tell the story. It's a good story, isn't it? Okay? I had $1 at risk. Everybody else lost what? 22. What did you lose? $1. Even if the stock went down to 30, then they turn around and they go, just kidding, Larry Ellison is still alive. Okay, and the stock rallies right back up to maybe 55. Okay, what do? You make your buck and you're out. Think about how high of a probability, okay, this has. And I'm going to reiterate that again. Think about how high of a probability, okay, this logic may have. Okay, it's huge. This is what you need to do to limit risks. By the way, I've enunciated several bullish trades to you. Let me ask you, could you do this trade bearish? Okay. Could you do this trade on the bearish side? Because it's important that you guys get this. Most important thing tonight to me is that you, okay, understand. Risk a buck to make a buck. Risk a buck to make a buck. But at the same time that you're risking a buck to be able to make a buck, you have a much higher probability of making money than losing money because you become impervious to the downside. And I like to use that term, impervious to the downside. Who cares? I lose on lots of strategies. It's all right. I lose a buck. But you know what? The probability, okay, of me actually making money is considerably higher. And that's a huge portion of the logic. Listen, this is why you want to use in-out spreads. Overcomes the high probability being stopped out, defines your risk, right? Limits your capital exposure. You never need to buy or sell the stock, provides a high probability of success. You can initially be wrong in terms of price movement and still come out ahead. You need this in your life. You want to see it in real terms? Here's real terms. Now, we are on, okay, a trading application. This trading application happens to be none other than TD Ameritrade's Thinkorswim, which is now, it's crazy to think about this. So 20 years ago, I helped in building version 1 of Thinkorswim. Here we are, okay, 20 years later. It's not only the largest trading application in the world, it now belongs to the largest brokerage firm, retail brokerage firm in the world. Charles Schwab just bought TD Ameritrade. A big portion of that deal was because of this trading application, okay? A lot of the mathematics and so forth, we helped put these things together, okay? And when I say we, there's a lot of people here at TheoTrade that worked right here. Listen, here's Oracle. This is the example that I've been taking you through isn't, just like an example I pulled out of thin air. It's real. It's Oracle. Okay. Oracle's trading at $53. Here's the in-out spread. I go out. Okay. I buy the 52s. I sell the 54s against it. The strategy is actually done for $1 debit. Here's the entire, okay, strategy, how it's actually laid out. I use the Jan 24s. That's 38 days. Okay. And the next what? In the next 38 days, I need Oracle to go where? Higher. How much higher? Not that much higher. I mean, it's got to move up negligibly. If it moves up negligibly, what am I? Profitable. What happens if I'm wrong in the near term? I don't know. If I'm wrong in the near term, that's okay. I got 38 days to be right, 38 days to be wrong. I'm going to laugh. I'm going to cry because in the end, I only have $1 at risk. Again, make yourself impervious to the downside. I know everybody wants to reap all the benefits, all the profitability in the world. You want to be profitable? Learn to cope with your risk. You want to be profitable? Learn to cope with the risk. And I'll tell you what, I believe that you can cope with $1 of risk. I don't know how many contracts you want to trade. I don't. Okay? One contract. If you did one contract, because some people don't know options. This trade, if I just did this one contract, would be a $100 debit. Every single person here can take a $100 debit. Then you're going to ask me about commissions. Good. Commissions on the entire spread are going to be $1.30. Even in today's free commission worlds, commissions are $1.30. It's kind of an afterthought now. By the way, there's some firms now, literally, there's 0 option commissions too. It's a $100 debit. For $100, okay, what can you make? $100. But you have a very high probability of doing so. Okay? It's incredibly important. Listen, in-out spreads, this is the stuff that you want to do. A moment ago, I was showing you Starbucks, right? I was like, you could do this and this and this and this. Okay? You want to do one in Starbucks? Starbucks is an $88 product. Why don't I just go buy the 87, for instance? 89 spread. It's trading for right around $1. Okay? Wait, why don't I go into, listen, I can go to underlying, to underlying, to underlying. You name a product. Okay? You name a product. And somebody asked a great question like, what does this need to be in a bullish trend? I don't care. Okay? In fact, why don't I show you a couple of bearish trades? Maybe Starbucks, is it bullish? Is it bearish? It was bullish until it turned bearish. I don't care about the direction because all I need is a little volatility. I need a little volatility, a little higher, a little lower. Okay. I'm telling you, it's not about direction. It's all about, okay, the right trading logic in here. It's all about the right trading logic. All right. In-out spreads, they give you the power to trade massive stocks and index products with just mere pennies at risk, people. Pennies at risk. You tell me, think of a wildly volatile underlying. Oh, fun. Somebody said Boeing. I have it on Boeing. Okay. Somebody give me a wildly volatile product. Something that you would strike fear into the hearts of anybody involved in markets. Okay. Like what stock strikes fear into the hearts? I love it. Everybody got it. Everybody got the one I was shooting for. It's Tesla. Okay. It's awesome. Okay. Tesla should strike fear into the hearts of everybody. Okay. I've traded this and I've traded it extensively as of late. Okay. I have a goal. Okay. To make enough capital in Tesla. Okay. To buy the Tesla. All right. All right. I already own one. But the next one is on Tesla. This has actually gone extremely well, and I'll show you here momentarily. Inside of Tesla, it's a $378 product, okay? It moves a lot. If you haven't looked at Tesla, let me come off the slide deck here. Like, listen, let's just go to a live trading application, bring up Tesla, okay? Tesla, this thing has been Mr. Toad's wild ride lately. I mean, this is Tesla before the last earnings at 260, but forget all that, okay? Forget all that. You have to recognize, all right, over the last 3 years, this thing bottomed out recently, as early as 6 months ago, this was a $180 stock. Now it's approaching $400. You look at this and you go, this thing's insane. I don't want to trade this. Why not? Why not? Because right now I have $1.25 at risk. What am I doing? I'm using an in-out spread to mitigate my risk. I have a 377 half, 380. 377. I'm buying the 377 halves. That gives me the right to buy the stock at 377.50. Then I'm selling, okay, the 380s. The trade is done for $1.25 debit. Okay, $1.25 debit. How much could I possibly lose in this trade? Okay, $125. That's it, people. Can you handle it? Because this is the product that strikes fear into the hearts of so many. $125 at risk. Okay. And people, put your money where your mouth is. All right. Let's do it. Okay. I'm actually going to go to my monitor tab and I'm specifically going to pull up Tesla just to show you what I've done in just the last couple of trading sessions. Like a couple of different strategies in here. Here's one where I put on for a 20-cent debit. That trade was exited for an $11 credit, right? Not half bad, but okay. Here's also a number, okay? A number of in-out spreads in here. Ironically, when are they placed? There you go. It's today. So this isn't just, an example. These are live positions. This is a live trading account, okay? All of my activity and positions, they're right here in front of you. So I trade in front of people constantly, all day, every single day, because if we're going to do it, let's do it. I mean, here's the strategy right there. I am highlighting it for you. That's what we just talked about momentarily on the slide deck. Why do you think it made, the slideshow? Why? Because I did the strategy. But I did one that was $2.50 wide. I did one that was $5 wide. I was playing around with some different numbers in here, depending upon if you wanted a little bit more risk, a little less risk, tailor it to yourself. You could trade Tesla with as little as $125 at risk. But you don't have to do a small amount. You want to do it big? Do it big. Okay? That's fine with me. You could do 10 contracts. If you did 10 contracts of this trade, what would your risk be? What would your risk be if you did 10 contracts? Be 1,000, okay? $25, $1,250. Apologize. $1,250 in here, okay? With 10 contracts. Again, your risk is tailored to whatever risk that you want. Tesla, again, strikes fear into the hearts. Somebody else mentioned what about BABA? Okay, what about BABA? What about it? It's ironic that you mentioned that because, again, I have strategies in there as well. Okay. Pull up BABA. You can actually see I've got positions in here. Got positions out here as well, right? These happen to be bearish ones too. So I'm actually sitting in a multitude of bearish positions in Alibaba. Why? Well, it's because that's the strategy that you have to employ in an underlying that's Mr. Toad's wild ride, all right? Boeing. I'm in positions inside of Boeing as well, okay? All of these strike fear into the hearts. Let me actually take you through a couple of strategies, okay, that I've placed recently, specifically with the in-out spread. This is the XLF. It's the financials. So what I'm going to show you here, these are live in-out trade examples. Now I say examples. Each one of the examples that I am displaying to you right now, I decided to display to you almost every in-out spread that I have done, okay, recently. And when I say recently, I'm actually using this quarter. Predominantly, we're going to say October, November into December. I mean, we are. We're only, 2-3 weeks into December. But I'm going to show you almost every trade that I did with in-out spreads, okay, in the last basically 3 months. This is an XLF, and I want to show you how this works so that everybody's on the same page. Here's the XLF. This is the exact time, okay, and date that we opened it. I'm going to highlight that even better. That's the time and date we opened it, the time and date we closed it, okay? Every trade that I'm showing you here has been done live and was done in front of a crowd of several thousand individuals. Here's the opening position, okay, and closing position in the XLF. This is what I opened the position for. This is what I closed the position for, okay? Every $84 invested in here, I got $153 back, okay? It's an 82% return in the financials. Now this one, okay, ironic, this was a bearish trade done in the financials. If you haven't looked at the financials, they've been straight up ever since, okay? This, and when I say you haven't looked at the financials, they've been straight up. So I did a bearish trade, okay? I did a bearish trade. You were looking at the bearish trade, and that bearish trade was done right in this time frame, okay? Made money. Things been nothing but up thereafter, okay? Hey, it's an in-out spread. Did I know the marketplace was going to rally? Absolutely not. Neither did anybody else, okay? I know. Somebody always knows something. It doesn't matter, okay? Listen, what our members are saying. Use this strategy, okay? Double a small account, like Dylan T, who wrote in. The in-out spreads have been very helpful as I've been able to get on a hot streak and double my small account in 4 months via the use of these in-out spreads. The other aspect is minimize your risk by limiting your account's exposure in the market, like Phil S., who wrote in to say, using the in-out strategy, last week I locked in $1,275 in some HAL put spreads, and today I locked in profits of $1,240 on several positions I identified. I've been averaging 7% a month for the last 4.5 months, profits of over $11,000, and I've never had more than 25% of my account at risk, usually much less. Here's another strategy. Again, example, Netflix. Netflix was actually opened on 10/16, closed on 10/18. For every $125 invested, I got back $195. It's a 56% return on this. By the way, the trades that I'm showing you right now, where do they come from? These were, okay, screenshots taken specifically, okay, from my trading account. This is everything I've done here, just so you guys see. This is everything I've done in this account over the last 90 days. Now, I don't want to intimidate anybody. I trade, okay? I trade. The number of orders I've placed, 364. The number of fills, 383, okay? I trade. So I'm trading what? On average, three times a day, okay? At least 3 times a day. And what I did is I actually went through and I isolated all of the vertical spreads that I did, both opening and closing transactions, and those are what I'm showing you right now. So you can see every single trade that I've done in here, okay? Apparently I was a Caterpillar madman, okay? I was a Roku madman, AMD, Apple, okay? XHB, it just goes on and on. Target, Verizon, Amazon. Here, let's go through a couple more of them. So this is my Netflix trade, opened it for $1.25, closed it for $1.95, right? Silver. SLV. This is actually the ETF for silver. Opened this on September 30th, closed it on October 14th. For every $46 invested, I got back 70 bucks. I want to remind you guys, okay, this doesn't have to be $46, right? What could it be? It could be $460. You could do 10 contracts, returning $700. It's a 52% return, onward and upward. From SLV, let's go to the XLE. What's the XLE? This is another ETF. Anybody know what this is? It's the energy sector. I went out there and I risked exactly $1 on this one to return $1.55. For every $100 I invested, I got back $1.55. Right? This happened to be a bullish trade. So you'll see it kind of a mix. The silver trade was bullish. Okay. The XLE was bullish. Amazon. This is a bearish trade. Okay. There's actually an Amazon spread. It was bearish. Obviously opened one day, closed the next. This is an earnings related trade. I paid $1.25, closed it for $2.47. Right? For every $125 I invested, I got back $247, a 98% return surrounding earnings. Yeah, you can do this around earnings too. Okay. We teach you how to do that. Target in-out spread. This is the target one. Opened October 4th, closed on Halloween. Okay, every $98 I invested, I got back $152. This happens to be none other than a bearish strategy, a 55% return. Home Depot. In Home Depot, opened on October 14th, closed November 5th. For every $229 I invested, I got back $373. It's a 63% return. Okay, Caterpillar, I told you I had cat fever. Caterpillar, I traded this both bullish and bearish throughout the month because the stock was oscillating quite considerably. For every $90 I invested, I got back $141, a 57% return. Here's actually a Disney trade. The Disney trade, this was actually earnings related trade. So everybody's aware it's an earnings related trade. I believe, and it's, again, opened on one day, closed the next. For every dollar or whatever, $100 I should say I invested, I got back 140. It's a 40% return. Here's actually Roku. I know a lot of people are scared of Roku. No need to be scared of Roku. This actually trade was opened on November 20th, closed on December 2nd. For every, $250 turned out $4, so that's $250 I invested. I got back $400. It's a 60% return. People, I can go all night. I could literally take you through every single trade that we did in here. By the way, I'm missing a couple. There were actually trades that were done in EFA. We can match them all up in here. Here's Netflix, American Express. Look, there was an American Express trade, right? XLE, SLV, XLF. There's a multitude of those. There's actually the Roku trade. Okay, the SLV. As I kind of scroll up and scroll down, you can see every single entry and every single exit inside of here. And I have no problem. By the way, there's the EFA close. Okay. This is one that was just a marginal win. I'll take it. Okay. I got out of EFA alive and I'm thrilled about it. All right. Bank of America. I got out of it alive and I'm thrilled about it. Again, I can go all night long showing you example after example after example after example trades as recently as literally today. Look, here's the Tesla spread I placed today. Here's something I did in the XHB. Here's an Alibaba one. Okay. Here's another XHB. It goes on and on. JP Morgan. Okay. I'm trading them all. Why? Okay. Because I have very small amounts of defined risk. And I know that it looks like a lot in here, but you got no time. It's no problem. Each and every trade shown today was displayed live at TheoTrade. The trade results we are showing are perfect for part-timers. Okay. You don't have to sit there all day with this thing. The in-out spreads, it's completely hands-off. Actually uses set and forget order types, meaning that after you put the strategy on, you don't have to physically close it. You're actually going to set up, okay, what's termed a good till canceled order. Okay. And there was something that we mentioned a little bit earlier today, and people maybe picked up on it, maybe not. There's a very specific and a very targeted percentage return that we're trying to achieve on these strategies. Okay. We can show you that, but even a fraction of your time is enough to see results. This is not hands-on kind of stuff. I love this because somebody's head's like buried inside of the computer. Because you saw a moment ago, I traded 386 times. Okay. That doesn't need to be you. The number of in-out spreads I did, yeah, I did a couple of dozen in-out spreads, a couple of dozen trades, negligible amount of time. Once you know how to do it, fire at will. I place them. You can follow them. In fact, here, characteristics of in-out spreads. The attributes of the high probability in-out spreads, they're undeniable. You never have to buy the stock. You define your risk. Risk is limited to precisely your comfort level. You do not need to use a stop order. Using a stop order defeats the whole purpose. You can vary time frames and not pay more. The probability of profitability is high. It's the perfect spread to reduce risk of a stock portfolio. I mean, how many people right now realize markets totally nuts right now? Totally nuts. Okay? We've hit levels that you have to look at. Even the most cockeyed optimist out there is looking at this market going, this is ridiculous. Okay? It's all Fed created. If you want to get bullish though, what do you think is a better way? To get your life savings, pack it all in there, put your whole life savings at risk. Or maybe use a couple in-out spreads, right? I'm trying to save people capital because we've seen this movie before and it does not end well. Even if you want to be bullish, be bullish. I'm telling you, be bullish, but do it without putting your life savings at risk, okay? Reduce risk of a stock portfolio. It's also an excellent tool for those seeking returns, maybe building a smaller account. That's what this is about. It's about small account growth. But at a time like this, forget small account growth. How about protection of your life savings, your 401k, your IRA? Look, that's why I pasted the Tesla trade down below. You're trading Tesla for $1.25. I can do that. But you got to be able to build this thing. And do not let options intimidate you. I've heard everything. I don't know if I can learn this stuff. Okay? You can learn this stuff. I don't care whether you're 23 years old, okay, or 73 years old. Everybody can learn this. If I put it in context, okay, you have your life savings in the line. Trust me, you'll learn it. The spread below is being done for $1.25 debit. But you got to understand that spreads, okay, these things are analogous to a massive power saw. And I always use this analogy for options. Options are the quickest, the fastest, the safest, the easiest way to get where you want to go with your money. But if you don't know how to use options correctly, maybe you lop off a couple of fingers. It's the same thing as using like a handsaw. You wanted to build a house. What do you want to use? A handsaw? No, of course not. You're going to use a power saw. But if you don't know how to use a power saw, you're probably going to take off a couple of fingers, right? You want to trade something like Tesla? Use in-out spreads. You can do in-out spreads. Maybe you don't know options, limited experience in placing options. Don't let them intimidate you. You need these strategies for the foreseeable future. Again, you're one tweet away. You're one misstep from the Fed, misstep from the IMF, misstep for Christine Lagarde, who now runs the European Central Bank. One, okay, word away. People from losing a third of your life savings. Don't let this crap happen to you again. We can show you how and when to place in-out spreads in a matter of a few hours. What we do here at TheoTrade is we create detailed recipes for every trading strategy, including in-out spreads. You got to think, okay, step by step by step logic. You wouldn't bake a cake without a recipe. Unless, of course, you've done it 20 or 30 times. But why would you trade without a recipe? You need to go through sequential steps to be able to place in-out spreads, okay? When I say sequential steps, listen, this is what you need to know to successfully enter and exit in-out spreads. First step, what makes a viable in-out spread candidate? What stock are you going to do? Oh, obviously we did Tesla, we did Amazon, we did Roku, okay? We could use any of those, right? Wish that was that easy, because what volatility should you seek out? You know, too much volatility, you're dead. Not enough volatility, you're dead. You have to know what volatility to seek out. And underlyings fluctuate in volatility. What options expiration do you select? You know what? Did you look at the options chain a moment ago? Look at the options chain here in the XLF. The XLF is a pretty good one. Look at the options chain. You could do 14 days, and 17 days, and 31 days, and 38 days, and 45 days, and 94 days. Set, hike. I mean, you don't know there's a lot of options on them. They're options, okay? What options expiration do you select? What should be the delta of the option I buy? What is delta? The rate of change of every option for the dollar move in the stock. Forget about the definition. We'll tell you the delta of the option to buy. We'll tell you what options do I sell against my position. We'll tell you exactly how to build the trade. We'll tell you exactly what right risk is for you. How can we do that? You tell us what's in the account, okay? It'll actually definitively tell you this is how much you should be trading, okay, per strategy. Let me show you what we do here at TheoTrade. TheoTrade creates recipes in trading. Trading's all about answering the what ifs. What might be a good stock or ETF candidate for an in-out spread? We'll tell you the correct options expiration cycle to buy your in-out spread. How much capital do I commit to these in-out spreads? What strike price options do I buy and how many? Okay, in growing a small account, what should my allocation be? Everybody wants to grow a small account, right? Everybody wants to take the $3,000 account and turn it into 10, 15, 20. You want to parlay that up. You have to be deadly accurate with your allocation. What we do here, we provide those answers. TheoTrade has your answers. We build recipes with definitive criteria. They're literally checklists for each strategy, each unique variable. All right, when we talk about checklists, this is like a pre-flight checklist. But once you're actually into the trade, what if the stock goes up? What if the stock goes down? What if the stock stays flat? What if a dividend is coming? What if expiration is coming? What if the stock sells off massively? TheoTrade has the answer to all of your questions. We'll give you the right probability for the trade. How many option contracts do I trade in my account size? When do I close the spread? What if the stock sells off big? What's the correct return for the strategy? What if the stock rallies massively? Can I fix a losing trade? It's how, it's when, it's why, it's at what price. And that's just the beginning of the many variables you're going to face while buying an in-out spread. Okay? People, listen, you can read what an in-out spread is, and you could read about it all day long. You might even know right now how to build an in-out spread. I'll tell you what, you can go out there. You could probably Google what an in-out spread is right now, and 20 different pages are going to come up. None of them are going to have this. You need TheoTrade's recipe for success. We've got 20 plus years trading experience, access to client order flow for 15 years. We viewed and studied millions of trading accounts, ran education for 15 years at a firm with the largest options order flow in the industry. Criteria is your recipe for success. The following strategy, the in-out spread, and the corresponding criteria requires the utmost attention to detail. And we spent years fine-tuning this trade setup and this criteria. And when we approach the section on criteria, you have got to follow the steps to build a trade. Okay? The guide to small account growth with in-out spreads. This is a course. It is ready for you now. It is a 4-hour course. It is available immediately with 24/7 access. Okay? The class slide deck that includes entry and exit criteria is available immediately for download. The course is archived 24/7. By the way, you can download the course on TheoTrade Mobile, okay, for iOS, which is Apple, and or Android. The course is $497. So stick with me because I want to take you through, okay, some of the key points that are in this course, and we're going to provide one little kicker tonight. I also want to remind everybody, okay, the end of this presentation, we are going to provide you the SPX indicator, right? The expected move indicator that I promised everybody right at the front of the presentation. We're going to give you that in just a few minutes. So the guide to small account growth with in-out spreads, it's ready. We have refined the criteria for this many times over. Okay? Class is $497. People, you're going to spend $497, okay, on one of these trades. Why not spend $497, learn how to do it correctly? Here are some of the key points. Small account, okay, in-out spreads. For the most part, this is the curriculum. You're going to learn to construct in-out spreads. They're easy to learn, easy to place. How to buy long duration options without paying more so you can give yourself the gift of time. meaning that we're going to learn to extend these trades, how to use defined risk-reward strategies, never have to lose sleep over your positions again. In-out spreads are used in any market condition or direction. We showed you both bullish and bearish trades. Okay, people are asking about retirement accounts. Good, done, no problem. Okay, build your own in-out spread with detailed step-by-step entry and exit criteria. In-out spreads are easily managed with set and forget, what we term good till canceled order types. These in-out spreads can be done with a trading account of $2,000. All of these trades can be done in retirement accounts with minimal options experience. I know everybody tells me I can't get the options experience. We got you. Okay, we have a relationship with all of the largest of the brokerage firms to actually walk you through, okay, to get you account approval to be able to do this. All right. We will also deeply discuss in this course capital allocation, which is position sizing techniques, so you can grow your small account. Follow the recipe to build a trade, the most important aspect of this course. I mean, people are, why am I paying $497 for the criteria and for access to that criteria? And I'm telling you, you'll go through this course. It's a 4-hour course. You'll go through that course 3 or 4 times, and you'll constantly pick up more. Okay? You're going to save yourself 100 times over the $497. And people try to figure out some of the criteria on their own. It's ridiculous. Okay? You spend the $497, you're going to learn, okay, a lifetime of invaluable information. Everybody here comes tonight. You want a bonus? Well, TheoTrade, we go beyond one class or one indicator. Everybody, they want everything, okay, to trade and invest, and they want it at one place and at one price, okay? I am very aware that people that come out this evening, they've been to this course, they've been to that course, they've listened to this webinar, they sell them this for $497, then you got to buy an indicator, then you got to buy this, you got to do a little dance, you got to make a little love, you got to get down tonight, you got to do all this crap, and by the end of it, you're paying thousands of dollars. We don't do that here, okay? We're about everything to trade and invest. We're about one place, one price. That's what we do here at TheoTrade. Bonus number 1, we have access to over 86 trading classes. Let me make this crystal clear for you. You will enroll tonight, okay? And tonight, we will give you access to not only, okay, the in-out spreads course, which is the guide to small account growth with in-out spreads. Not only will we give you access to that course, we'll give you access to every course that we have ever done here at TheoTrade. This is just a smattering of the courses. All of them are available immediately. It's going to be access to over $9,000 in classes alone. And there is no other, okay, education firm out there, anywhere, at any price, that is going to be comparable to the course and the curriculum that we provide here at TheoTrade. Okay? I'll put money on that one in a second when people have no idea like how many instructors we even have here. This is not just me. It's not just Don Kaufman. Okay? We have obviously the in-out spreads course, how to collect income being short, the next big short, that's the risk twist spread, the guide to selling high probability spreads, iron condors for income, selling premium, okay, and minimizing your risk, survive and thrive in extreme volatility, day trading NASDAQ futures, covered calls, essential skills for consistency in trading, top 10 skills for growing a small account, pairs trading, 86 courses. They're not just my courses. Again, it's over $9,000 in classes alone. Jeff Bierman. Okay, these are the instructors. Jeff Bierman, analyst, trader, and former chief market technician for TD Ameritrade. If you've ever used TD Ameritrade's charts, specifically Thinkorswim, that's the guy that helped build most of them. I'm not your chart guy. This is one of your chart guys. Next, Matt Williamson, market neutral premium selling option strategist. Some people want to come here. They want to learn to sell premium. Good. That's why we actually brought aboard Matt Williamson. Okay. That's a guy, does many courses here. Next, Corey Rosenblum. He's our resident senior strategist. That's our swing trader. You want to trade a little futures, okay? You want to swing trade stocks? It's Corey Rosenblum. Next, Brandon Chapman. Brandon is also a veteran from none other than TD Ameritrade. He's a CMT, macroeconomics, technicals, and fundamentals, okay? Bar none. One of the smartest in terms of macroeconomics, okay, out there. Steve Slim Miller, 43-year veteran of stock options and futures. Slim actually has been trading and started trading in Chicago, in the early 1970s. Last but not least, Tony Rago, NASDAQ futures and intraday strategist. Oh, I didn't mention the best part. Jeff Bierman's also a professor of finance at Loyola. You want to see Jeff as a professor? Cost you $42,000 for a year at Loyola. $42,000 a year, or you can have him here in TheoTrade. Okay, that's your first bonus, is access to 86 trading classes. Your next bonus, all access TheoTrade VIP membership pass free. We will give you 3 months unlimited access to TheoStream. You're like, I don't even know what that is. It's a live trading chat room. We broadcast for 6 hours a day live. Okay, what do we do for 6 hours a day? We trade. I know that not everybody can make it. Okay, maybe you can only hop in there periodically. Doesn't matter. It's yours. Free. It's 3 months. Okay. We give you all these real-time trade ideas, market insights, real-time analysis. Okay. We're shooting out all this through push notification. Emailing trades, passe. We do text, and push notifications, including in-out spreads. We'll shoot that out. We actually shot out today the Tesla trade. We have 5 distinct trading portfolios. We have daily coaching sessions, which is continued education every single day with timely topics in stocks, options, and futures. And our instructors directly answer trading questions via email. You get email support with TheoTrade. You do not pay extra. It's access to $997 in support, trades, and insight. We're giving it to you, tonight. In addition to this, so we're actually giving you access to every course we've ever done. We're giving you access to our live trading chat room, which I'll show you here in a minute. I'll show you exactly what it looks like. We're also giving you access to every indicator and every scan that we've ever built. There are 59 proprietary indicators and scans. This is where they get killed in paying for this stuff. Auto expected move. That one is the most complicated script ever put together on the Thinkorswim platform. Ever, by far, bar none. We have S&P 500 gravity points, TheoTrade RSI, Laguerre, Quantix, NQ levels, next generation squeeze indicator. You go to other sites and they're going to charge you $500, maybe $1,000 for each indicator. We give them to you. By the way, the SPX expected move, I'm about to give that one to you right now here in just a moment. All of the indicators are given to you tonight. It's access to $1,800 in indicators in scans. Listen, TheoTrade includes everything you need to invest in trade. We have classes, coaching sessions, email access to the instructors. We have a live trading room and live trades where you could actually talk to the instructors, talk to the other clientele. We have indicators, we have scans. All of it is also available on mobile access. We've built mobile applications. Everything you need to succeed. We've effectively built the Netflix. TheoTrade, it's the Netflix for traders. A genre of trading, it's in there. Tonight, it's $297 for 3 months. That includes everything we just talked about. The high probability in-out spread course, right? That's the growth of accounts through in-out spreads. That's included. Access to 86 trading classes, new monthly classes. So, people think to themselves, well, Christmas is coming up. Yeah, we have classes coming up. We don't ever stop. Yeah, Christmas is coming up. Fantastic. It's a Christmas present to yourself. Now, when the rest of the family, is finally annoying you on Christmas, night, after dinner, you can come in here and actually tune into a couple classes. Listen to some of the archives over there. We'll be broadcasting, all throughout Christmas and New Year's week. The only time we take off is pretty much Christmas Day. That's it, people. 59 indicators. We broadcast every day. You email out those trades. We actually send text messages now, push notifications. Daily coaching sessions, stocks, options, and futures. And we are giving you direct access to our trading instructors via email. Go now to theotrade.com/IN. It's theotrade.com/IN. That's important. Now, I'm going to give you a little bit of a kicker. This is everything that is included tonight, right? And it's $297 tonight for 3 months. Everything for 3 months. No if, and, or but. By the way, somebody's already asking, is this a membership? What happens after 3 months? If you don't love us after 3 months, part ways. I'll still love you. It's okay. By the way, if you want to continue after 3 months, tell us, continue. It's another $297. Okay. This is not like an introductory price. It's $297 for 3 months. You want to do it for another 3 months? Another $297. Okay. We're not about that. Just so you guys know, we have 4,000 members now on TheoTrade. Okay. But it's not a membership. Everybody just decides every 3 months whether you want to do it or not. And again, we're fine with that. Here's the real kicker. We're going to make this a riskless trade. TheoTrade is a riskless trade. How's that? Everything you need to start trading tonight, from novice to expert. A little bit of a money back guarantee. Trade with us over the next 3 months. If you're not satisfied, just email us, support@theotrade.com. That's the email right there. Provide us details of your trades. Okay. If you're not totally satisfied, receive a full refund. By the way, here's some stipulations, because sometimes people just tune in for 3 months, they sign up, they do nothing. Okay. Here's my stipulations. In the next 3 months, you got to use 10 trades, and you must use the in-out spread criteria. Okay. And I'm not going to be too hostile about that, but don't tell me, I went out and I bought some calls and then I bought some puts and I lost money, because that ain't in-out spreads. You got to make this fair. If you give me 3 months and 10 trades, okay, and you're not satisfied, I'll give you a full refund. The initial count value, you got to have $2,000. By the way, you must follow the TheoTrade criteria for in-out spreads. I'm not playing a game. Follow the criteria. Step 1, step 2, step 3. You'll see the criteria in the course. Okay. Right after you enroll for it tonight, hop in there. Go look at the criteria. By the way, you have to provide real account statements of trades. This ain't paper trading, people. You have to actually have traded it. I don't want to see like, I did paper trading and I gave up. It's real capital. You're not going to put a lot of capital at risk, because I'm going to tell you right now, you're going to be satisfied. But we still make it a completely riskless trade. Get into TheoTrade now. We're going to work with you guys directly, and I continually hammer that. There are only 30 spots, though, on the riskless trade deal. Because the riskless trade deal, okay, we have to actually look through your trades. People actually send us their trades and be like, hey, look through my trades. Did I do this right? I want to make sure that, we're good. Okay. We give you unlimited email mentoring. How much time do you think that takes? Okay. There are 7 full-time instructors. Okay. We limit it to 30 spots tonight. It's a matter of trade size as well. We trade live. We don't, how many people could possibly get into the same trade at the exact same time? You send us your trades. We do trade reconciliation. We'll go back. We'll figure out what you're doing. And the $297 offer has never been available before. Listen, this is what our members are saying. Thanks, Don. Just finished my very first ever quarterly trading report that grossed 21% return on investment. Thanks for all the help. Looking forward to your intraday course tomorrow morning. Fantastic service. I became self-directed with my trading through the education I got here. Just wanted you to know, okay, how much I appreciate him, okay, and what he does. For the first time ever, my account is in the green. Thanks, TheoTrade. I'm up $4,000 this week. Listen, this is everything, okay, that you're gaining access to today. It's $297. So it's the guide to small account growth with in-out spreads. That's the course. The first bonus, you get 3 months access to everything we do here at TheoTrade. Okay, live trading chat room 6 hours a day. It's archived 24/7. We email out trade ideas, portfolios you can follow. There's trading indicators and scans, coaching sessions. Bonus number 2, okay, we give you access to 86 classes. There's day trading, swing trading, technical trading, beginners. Go now. By the way, there's also new monthly classes to theotrade.com/in. I'm going to take you there right now. Again, theotrade.com/in. I'm also going to pop it up over here. You need to follow me to this link for the SPX expected move indicator. Okay, this is where the indicator happens to be, and I'm actually going to pop this up on the screen right here, right now. It's theotrade.com/in. That indicator, okay, happens to be located towards the bottom of the page. There it is. There's the download. SPX expected move indicator. We're also there in live support. This explains everything that is included. Everything that's included as you enroll tonight. Okay. It's $297. There is so much in here. In fact, I'm going to show you. Okay. And then I'm going to answer a couple of questions. I know that there's some questions, some one-off questions. I am going to answer those questions for you. For those of you, okay, go right ahead, click add to cart. When you click add to cart, all you basically have to do, put in your billing information. It's $297 in here. Okay, that's it. Okay, payment information, you're good to go. All right, let me go through, and again, I'm going to answer some questions momentarily. Before I do so, again, I want to reiterate everything that's included tonight. Okay, the in-out spreads course. Okay, the guide, of course, to what? Small account growth with in-out spreads. Okay, bonus number 1, 86 of our classes. Let's actually show you the classes. Bonus number 2 gives you access to everything we do, all the live trades, 6 hours a day of us broadcasting live, 5 portfolios out there and 59 proprietary indicators. More importantly, email support. Do not hesitate to email us. It's one of the reasons tonight, okay, that we do this like riskless trade and we knock it down to 30 people so that we can actually answer emails on a one-off basis for our clientele. I wanted to show you a little bit about TheoTrade. This is TheoTrade. This is what it looks like. This is the site. Let me actually pop this to a full screen. This is TheoTrade. Obviously, we're off air right now. This is actually the broadcast screen down below. Down below, this is all of our clients talking. Okay. On a day-to-day basis, we have several thousand people in the chat room. Feel free to chat in there. It's a party, people. It's a party at all times. Okay. Next, you want to know what the strategy classes look like. This is where you find classes. There's option classes. There's option newbie classes. There's technical analysis classes, day trading classes, trend trading classes, hedging strategies, futures, stocks, okay, pairs trading, mindset. Let me tell you about mindset. I just wanted to click on that for a second. Just the mindset, okay? There's a class in here that we originally sold right here, 5 Essential Building Blocks to Successful Trading. We originally sold that for $997. That was one of our standalone courses, back in the day. We sold that class for $1,000. Now, everything is included. We built Netflix, people, for traders. Everybody has a different genre. That's where we hired 7 full-time instructors to actually assist in their expertise in trading. Okay, it's all there. Somebody is totally overwhelmed. You're like, I don't even know anything. I don't know anything. That's why we have a start here menu. See where it says start here? This is where you guys want to start. You start here. Options 101, options 201, options 301, order execution, preparing for your trading day. Okay, getting your risk under wraps, what products to watch and why. Listen to these videos. Okay, what do these things even look like? When you click on a video, like what does it look like? Click on it, right? What does it look like? Here it is. You can even click on download the slide deck, right? This is it. This is what it looks like. You can zoom into a full screen. Okay, it looks a lot like what you're doing this evening. Okay, that's what an archive looks like. And again, you can click, you can download stuff on here. It's phenomenal, right? So there's your strategy classes. And we have a completely searchable index. We've built like the Google for trading. So if you come in here, you type in anything you want. We've been talking about like in-out spreads, in, out. You just type in like in, out, and it's going to pull everything. Happy hour, swing trades with in-out spreads. Okay. The ins and outs of in-out spreads, 2018 edition. That one was a peach, people. That one was out of this world. It's actually one of my favorite courses I've ever done. But I wanted to show you, it's completely searchable archive. Again, come right over here, okay? And I want to pull up the address once again. It's theotrade.com/IN. Click add to cart right now. People, I'm going to answer a couple of questions. And I'm going to answer a couple of questions for everybody. Make sure everybody's on the exact same page. Then we'll kind of continue forward. All right. Your questions answered. Then I'm actually going to read through a couple more questions that are popping in right now. Again, I'm also going to pull this address right to the corner of the screen in case you need it. It's theotrade.com/IM. Let's get started on the question over here. Okay. Everybody always asks, what do I need to even get started? You need a laptop and an internet connection. I mean, listen, we have everything that you're going to need to get started, from absolute novice to some of the most extreme traders. And some people think, I don't know anything. This is not for me. No, it is, because we've built, okay, an entire database of novice-based classes. Okay. Then some people think, I'm at the extreme end. I challenge you, the most extreme of traders in here, you're going to find stuff that'll blow you away that we do here at TheoTrade. Okay, from the novice, an absolute novice, to the most extreme. Number 2 question that always comes up, this is not a membership. We are not auto-renewing, or we're not going to bill you again. It's not a membership. You decide after 3 months what you want to do. Why do we do that? Because we're so sure that you guys are going to love everything we do here at TheoTrade. Okay, we pretty much put our money where our mouth is. I know everybody wants to rope you into something. Nothing. Okay, it's $297. You don't love us? Leave. You love us? Sign up again. Okay, that's the way it works here. Number 3, TheoTrade archives everything. Every word spoken here is archived. We understand that not everyone can watch trading. By the way, we actually have playback on mobile. So on number 4 here, we're going to provide you access to TheoTrade Mobile. Not only can you download the archives, but you can speed them up. You can listen to me at 3 times, okay, the speed, which is already really fast. 3 times, okay? I sound like a chipmunk. It's awesome. Number 5, you can email us anytime and receive a response within 24 hours. You can include trade-related questions. Listen, trade-related questions. I'm in this spread. What do I do? Don't email me with like 10 minutes to go to the close and be like, I need help. Okay? You got to give us 24 hours. We're going to answer your emails. Number 6, you will gain access to every course TheoTrade has done in the previous 4 years, including classes, coaching, live trading sessions. Everybody gets access to everything. All archives are searchable. Name a trading topic and TheoTrade has an archive on it. Number 7, all these trades can be done inside of an IRA or retirement account with as little as $2,000 inside the account. Okay? So with as little as $2,000 in the account, all right, you just got it. It's a retirement account, not a problem. Number 8, we at TheoTrade can help you get approved for options at several major brokerage firms. Okay? And by the way, sure, you can sell options, right, in a $2,000 account. Okay? Remember, there are 30 riskless trade spots available. What does that mean? Okay? If you want the riskless trade deal where we say, hey, you know what? If you don't love us, we'll give you your $297 back. You got to be one of the first 30 to actually sign up. Okay? We need you guys to understand that because it is a tremendous amount to support 4,000 people. We currently have 7 full-time instructors. In addition to that, okay, we have numerous traders helping in terms of email support. Listen, get results, take action, enroll for TheoTrade now. There's absolutely no risk to you whatsoever. Again, it's theotrade.com/in. All right. A couple things I want to also cover. I'm going to pull back up the web page over here. If there's any questions on this one, okay, now's the time over here, and I'm going to answer a few more, and then all right, make sure everybody's good. So you want to come in here, all right? You want to come in here and just enroll. Click Add to Cart. It'll actually pull up the cart. You can actually walk through theotrade.com/in. Let me start to answer question by question in here. So there was a question that came on early on. Is this a debit spread? Absolutely is a debit spread. It's a type of a debit spread. But this debit spread is more about the criteria. It's less like just a average, debit spread. It's more about the criteria and how the structure of the trade is wrapped around the underlying. By the way, another great question. Are you going to give us the lowdown on the differences between put credit spreads and in-out spreads? Okay. Chandra, absolutely yes. Okay. These are going to be in-out spreads are going to be debit spreads. We are not going to do the put credit spreads. They do not work very well in this particular market. This market lately, okay, and when I say lately, I am talking over the last 6 years, volatility is dead. Okay, selling option premium ain't what it used to be. So that will definitely be a portion of this. All right, continuing on. Somebody said never traded live, paper trading. Okay, and I'm down. I'm afraid to trade live. Okay, so I find option trading very confusing. Gary was asking this a little bit earlier. Gary, okay, we're going to walk you through the in-out spread and the construction of the trade. Okay, yes, you can go through and paper trade, but I am going to tell you to get your feet wet and to really understand trade, want you to trade live. Okay. And that's, listen, that's a big portion of your learning curve is trading live. But we're going to put you in trades. You can have as little, okay, as $50, even $100 at risk in these trades. Okay. And I believe that it's going to get you over the fear of trading live. Okay. And if it's even a bigger issue, Gary, we'll spoon feed you trades. I want everybody, though, to be able to kind of feed themselves in terms of trading. But initially, we are comfortable spoon feeding you, which is the entry and the exit of the position. Okay. Tune in and we will absolutely spoon feed you trades until you get your comfortability up. Okay. All right. So I love this one. What criteria do you use to select the companies? That was from George. George, enroll for the course. You're going to find out. I am going to tell you this. What criteria do I use to select this? Liquidity plays a huge role. All right. I'm going to give you that much. Liquidity plays one of the largest roles in the in-out spread. All right. So continuing on over here. Oh, you earn 100%, then pay 37% short-term capital gains. So wow, we're already worried about short-term capital gains. First of all, if you're worried about taxes, personally, I'm going to tell you this: taxes, the best problem you could ever have. Right? I mean, I started trading, back in the late 90s. Taxes are the best problem I've ever had. I like to pay them. By the way, if you have a tax issue, okay, and let's say you've made money over a couple of years and you have a tax issue, not a problem whatsoever. We can actually even send you to the right people to structure a corporation and let you trade in and out of there. Or, okay, you of course could use your tax deferred accounts. Nevertheless, when somebody talks about like 37%, I get a little nervous over there because there's a lot of products that you can trade that are, again, you could trade with the Rule 1256, the 60/40 rule. There's a lot of ways to circumnavigate some of the tax implications, even for the absolute novice trader, which we explain here as well. All right. Mike was saying, should exits be advanced orders? Okay. Yes, the exits will absolutely be advanced orders. Okay. Continuing on over here. Does this work for calls only? Absolutely unequivocally no. In fact, I do a lot more put spreads than call spreads. In fact, you can actually look at my account here. You want to look at my account really quick? Look at all those put spreads. Put. Oh, there's a call spread. But I actually prefer in a lot of cases to use the put spread. It's just it happens to be viability for the trade. Okay, I like it. Oh, I love this one too. I pissed away $23,000 in 2 months following Raging Bull. First of all, I have no idea what a Raging Bull happens to be. I need your help. If Raging Bull is another company and you actually spent $23,000 or lost $23,000, I'd try to get your money back because that is absolutely a ridiculous amount of money. You realize you're in one of the largest bull markets ever seen in the history, okay, of the world. How the hell are you losing money over there? All you have to do is throw money into this marketplace and it's making money right now. So Dave, I will help control your risk all I can. I mean, I'll do everything possible. You email me directly, okay? And I'll absolutely walk you through. And by the way, if you email me directly and you don't like the response that you get from maybe, one of our other traders, just put my name in the heading. It'll come right to me. I have no problem. I don't care if I answer 200 emails in a day. We will do it. Okay, we will do it. It's that's important to me that you know that we're here to actually answer those emails. TheoTrade.com/IN. I want to thank everybody for tuning in this evening. Again, we only have a handful of the riskless trade spots left right now. Does success with in-out spreads depend upon trend following? Absolutely not. Trend following is actually not critical. Trend following is not critical in this. If you're a good trend follower, fine, hop on the trend, but it's not critical. Ironically, one of the most effective markets for in-out spreads is actually just pure sheer terror and volatility. It's sheer terror and volatility is one of the best times to place in-out spreads because whatever you're going to do in volatility, you feel like you're wrong, but in-out spreads, just because the market's bouncing around so much, makes you so very, very right. Listen, we've gone way over the time tonight. I hope everybody enjoyed it. I like doing this. I like doing some of these presentations. By the way, you guys can hop into the chat room tomorrow morning. I'm kicking it off. It's tomorrow, Wednesday morning. I kick it off at 6:22 Pacific, 9:22 okay, Eastern time. I will go live in the chat room. If you could be there, fantastic. If not, catch us in the archives. Thank you, everybody, for joining this evening. Bye-bye.